Hello again and welcome to the Marc Oslar Retirement Experience. Glad you're here and thinking about your future and thinking about retirement and thinking about all of the ups and the downs of all of that can happen over the next 25 years and some of the angst that goes along with picking that person to help you through this and at least finding somebody to actually put something down on paper when it comes to a retirement plan. And that's really why we have the show each week. That's why we meet with Marc. And how are you doing today, my friend?
I'm fantastic, Randy. I hope you're having a great one.
Yeah, I think everybody who I talk to around the country right now is got whiplash, and it's not because of the stock market. It's because of the weather. It's like one day it's 75, the next day it's 25. So one day you're out in shorts, and the next day you got your coat and your hat on, and it's a weird time of year, isn't it?
It's completely unacceptable. We can't handle. Come on, look. Let's just keep praying. Lord, just help us here. All right, we want consistency.
Well, we're in the South, and we just started pollen season. So it was on Sunday. It got up to about 85 degrees in Atlanta, and I said, "This is the day. I'm going to go outside, and I'm going to come back yellow." And I did. So we have a lot of that going on right now. Are you experiencing the same thing?
Oh, yeah. I mean, we have black vehicles, and we have black vehicles in North Carolina, yellowish green hue all the time. Should you wash it off? No, there's no reason to. It's just going to come right back.
That's exactly right. So 2 weeks worth of that, then you can power wash the deck and do all that stuff that you got to do. But for right now, everything's on hold. That's for sure. Well, the up and the down of the stock market is another thing that we've been talking about. We've had some wild swings lately. I mean, it hit 50,000 and then it went down to 45. So, I mean, officially it was a 10% correction, but it sure didn't stay there very long. So now it's bouncing all over the place. So some people have said, oh, here it is. I got to get out. I'm going to cash. I'm not going to let this happen to me. And, well, congratulations. You now have a new bumper sticker. You are officially a market timer. Congratulations to you. So this is Lawrence Sprung. He's from Market Watch, and he's on Yahoo Finance. He says, you know what? This whole business of you trying to time the market and guess when it's going to go up and down is kind of futile.
And if you look at it, most down and up days are clustered together. Since 2000, if you invested in just the S&P, you averaged 9.8% return. But if you just miss the 10 best days over that period, just 10 days, your return goes to a negative 12.5%.
And that's on an annual basis.
Correct.
Yeah.
Correct. Yeah. So trying to time things and going in and out, it's not that fruitful, especially most people are not professional traders that they can time that really effectively.
And even those people don't know what they're doing. They can't do it either. All right. So, Marc, we can't day trade our retirement plan. I mean, there's no sense in that, but I just feel as though when people get into retirement, that is something that they take a new interest in. All of a sudden, they're checking their accounts on a more of a regular basis. Do they get a little more shook up when we see the market go down? Or can you put a plan in place and kind of sail off into the sunset and not worry about this stuff?
Oh, yeah. This happens. I mean, especially when you have less time for thinking about your 9 to 5, right? So you're thinking about your money, your nest egg. Mm-hmm. You're thinking about these things like, okay, my account just went up, from 230 to 240, but then it dropped back down to 225. Oh my gosh, what do I do? What do I do?
Mm-hmm.
And I hear these things all the time, right? And we have these conversations about what do you do? Well, we implemented a plan. When we implemented the plan, we said that this is the portion of money you didn't mind having some type of risk, and this is the type of risk we assessed. The other part of the plan was we said this is the part of the plan we didn't want risk. And this is if you went all in on our plan to understand of what we felt like we could help you with, right? So obviously, do we revisit it? Of course we revisit it. It's all about risk tolerance. It's about how we can help you in that moment. We're always ready to have that conversation. But market timing, come on, guys, let's be serious. It's very difficult to do that. But I had the same conversations in April of 2025 when we had the tariff talks. It was like April 3rd to April 10th of 2025. People were losing their minds. And then I said, guys, we can't react from this. It's the same thing with the war with Iran and the geopolitical risk that you have going on there. That's one of the biggest effects of the market, right? But at the same time, you have talks where the president says one thing and then he says another, and it could really flip-flop the market. Yeah. What we want to do is know what we know to be true, which is what are we trying to have in a risky position and what are we not trying to have in a risky position. And that's the conversation between preservation, and then how do we combine income and growth? And these are the conversations we have on the show.
I think if I took my microphone out now and did the man on the street thing and say, how you doing in the stock market? All I would get is, I'm down 4%, I'm down 5%, I'm down 8%, all that. And I would say then my next question is, how'd you do the last 3 years? And they go, I'm up 50%. Okay, so we, in human nature, we dwell more on losses than we do gains. It's the opposite when you talk to somebody who goes to Vegas. How you doing? I'm up 300. Well, you didn't tell me about the 400 that you just lost, right? So it's interesting that we dwell there. Do you find that people, they get more shook up and then they just kind of discount you could be up 20% and they go, well, maybe another trip. But if you're down 20%, holy cow, that affects my lifestyle. That's kind of what we have to guard against, isn't it?
We do. And let's just be honest, it's human nature. So when you look at it, you look at one of the greatest quarterbacks of all time. You talk about Tom Brady. Mm-hmm. Tom Brady actually talks more about his Super Bowl losses than he does his victories.
There you go.
I mean, come on, Tom. Are you serious? You've had enough. You have more than you fit more than one hand alone.
I know
right?
it.
No, seriously. But that's the whole part. Is we're always thinking about, oh my gosh, we're starting to lose. Oh no, we're starting to lose. Where'd you start? Where do we want to finish? Mm-hmm. And then what you're bringing up is a great point, Randy, because we're also talking about sequence of returns. If you're in the market, it's not necessarily the returns you have, it's the years of the returns you have in terms of what return did you get in any particular year based on the withdrawals you're taking as well, because that could be a huge difference at the end of the day. At the end of 5 or 10 years, depending on when the return came versus the negative, while you're pulling money out, it could be drastically different if you just switch those numbers up in those particular years.
Well, we've talked about it in the past is, your retirement plan should kind of be kind of in the same philosophy as an all-weather tire. You got to have, snow and ice and rain and everything that your tire can handle. That's kind of what your retirement plan should be, is having something that's built for all sorts of things that are coming at it. Market declines and tax going up and inflation going up and all the different things that we're going to be dealing with, to sit down and build that kind of a plan. Sit down with Mark. We do a no-cost, no-obligation meeting. That means that let's just sit down and talk about what you've done for retirement. You've saved all this. Great. Here's the places it's saved. How is it doing? Are you going to go into retirement with enough income? Are you going to go out with a big tax liability? Well, let's get all that figured out. That takes a little bit of analysis and a little bit of time. Let's get that going. Here's the website and here's the number, moretoretire.com. Just spell it right out, moretoretire.com. When you go to the website, there's a place for you to put some information there, and then Mark and the team will reach out to you, or you can skip all that. Reach out to Mark. It's 984-300-1984. 984-300-1984. So then the question is how much I should be in the market. Then where should my money be? And it was interesting this past week, Jamie Dimon, who's the CEO of JP Morgan, said, you should have money in the market, but you should also diversify to having money outside the market. Okay, to me that means a savings account, maybe a CD, a money market, but then I come up dry. What is it after that, Mark, that we could say I'm going to have some of my money in the market at risk and some of my money outside the market? What are those options?
Yeah, so you're talking about CD, money market, you're talking about a treasury. Sometimes people like to look at bonds and so on and so forth. I get it. So we want some preservation tactics built into your portfolio. We want some liquidity. 100% right away. All right, so here's the thing. One of the things that we always offer our clients is, hey, if you've got some market money with us, if you want to just keep some in the money market, you can do that. We don't charge a fee for the part of the money that you leave in the money market. That's one of the things we offer for our folks out there. If you want to know more about what we do, of course, we want to provide a convenience for the people we work with. Now, if you just want to go to a bank, I could always point you to the high-yield savings accounts out there to do those types of things. But what else is out there? Well, there's also two things out there that we've talked about before on this show, and those are fixed or fixed index annuities, and they're structured notes. Mm-hmm. And we've talked about structured notes before because they can be complex and confusing, just like annuities can be complex and confusing. But Don't we want to keep it simple on the show here, Randy?
Absolutely. Let's do third grade level to make sure Randy can understand it, okay?
Here we go. So basically, an insurance company and a bank are kind of doing similar things in the sense that they're both borrowing your money, right? So an insurance company for annuities are borrowing your money, and then they tell you the parameters of the contract. They could be based on some indexes. You're not directly in those indexes. Same thing with a structured note when a bank borrows your money. You're not directly in those indexes. The difference might be that the structured note might have a little bit more potential for growth than the fixed index annuity, but not in every circumstance. But the reason why you do either a structured note or an annuity is mainly because you want to build some type of less degree, and we call it correlation, things moving in the same direction. So you want to break up the correlation and build a preservation tactic. And how are they preservation tactics? Well, an annuity, the insurance company says, we're going to make this a very strong preservation tactic. And sometimes in some instances, you feel that way because you might get a lifetime income rider that might be called a guaranteed lifetime income rider, right? And when people hear that G word, they get kind of excited. And then they might have no downside risk to the market. So if the indexes drop, you don't have any downside. So what they'll do is they'll protect your upside gains and they'll take away the downside risk. On a structured note, what they have are things called buffers and barriers. And this is the easiest way for me to explain them. Let's say it's a buffer. A buffer means that if it's a 20% buffer, the bank will take the first 20% loss. So if you're related to some indexes and the indexes dropped 15% for that given stretch of time, then the bank will take that loss. You won't lose anything. If it drops 25% and it's a 20% buffer, the bank will take that first 20 and you'll just lose 5%.
Okay.
Alternatively, if it's a barrier, usually they give you a bigger loss protection. So let's say, for example, the buffer's 20, the barrier is going to be 30. But the difference is this. It's very important to understand this. If the market drops 25%, you don't lose anything, okay? Because they're going to take that loss. But if the market drops 35%, you broke that 30% barrier, that entire 35% is your loss. And that's the difference.
That's a big difference.
So structured notes have a little bit of risk involved.
Okay.
There's less risk involved with a fixed index annuity, but both are used, when you're looking for something alternatively to a CD or a treasury and you want to make a little bit better returns.
Well, when you think about it, there's not a whole lot of places to put your money. I mean, there's the stock market, so you got your stocks and bonds, and then you've got your banks, which you got your CDs and your money markets. You've got your insurance company, which you got your annuities, and then you've got real estate, and you can go anywhere you want to with that. So, I mean, there's a lot of different places to put your money to explore all of them. I would want to see all the options that are available to me to spread out that risk of retirement, and that might be the conversation you want to have with Mark and the team. Give him a call, give him a look on the website, and let's get a date on a calendar and just talk through it. It's a no-cost, no-obligation look at your retirement. And you say, this is what I'm bringing to the table. I got a 401k. I got some savings over here. Maybe you own a property or something. Maybe you got a pension coming in, something like that. Let's evaluate all of that, see what's coming in, then what's going out, and just really have that important retirement conversation. MoreToRetire.com is the website, or 984-300-1984. 984-300-1984. All right, we've talked about the benefits of a Roth conversion, but the question is, when? When should you do it? Should you wait until you get into retirement when your income is down? Should you start in your 60s? Should you end in your 70s? What's the deal there? Well, this is Sean Mulvaney from Morningstar. He says there's a sweet spot. Between the ages of 66 and 69 is the best time to do it.
So these 4 years, the world tends to be our oyster. And during these 4 years, we have a high standard deduction. And we now have the senior deduction. Now that's quote unquote temporary for 4 years. We'll see if that is really temporary or not. But regardless, these 4 years tend to be the best Roth conversion years because we don't have required income. We could delay Social Security. We're not managing for premium tax credit. These are the 4 years I think most retirees should be most thinking about Roth conversion. conversions.
Okay, so I have talked to people who say you got to get this done by 60, otherwise it doesn't help you. This guy says 66 to 69. I've heard people say even after you're doing RMDs, you can still do it. What do you see? Is he right here with this sweet spot? Is that what you find, or what's your opinion on that one, Mark?
I think it's possible that he's correct in some aspect, but not in every aspect, because I actually have retirees that retire ended up having more income in retirement than they did in their working years. Mm-hmm. That's not always the case, but I've seen it happen. And so that's why the conversation has to happen earlier, right? We want to have this conversation of when do we want to start if you actually want to do Roth conversions, when do we want to really attack this? And that's why we have to start out with that conversation, but I get it. Like 66, 69, typically if a person has less income in retirement, they've retired, they've gone on Social Security, Medicare, all that stuff, we've worked everything out. Generally speaking, those are some really good, strong conversion years. But I've had clients that retire early, in their 50s and early 60s, and we start converting then. And it just depends on what's best for that person. I also have clients that literally will tell me, hey, what if they repeal the tax code? I don't want to go convert to the Roth IRA from the IRA, and then they repeal everything, and then all of a sudden I miss out on something because I've done something, then and there's no more government qualification. And I say, well, look, I'm no respecter, but what I'll say is this, that if you want to be certain about what you're doing, you could always convert if you really want it to be income tax-free in the future. If you convert to a Roth IRA, you have to wait 5 years for the gains to become tax-free, not for the principal of what you paid the taxes on. You see, when you contribute to a Roth IRA or convert to a Roth IRA, they always allow the contributions to be taken out, but not the gains. And that's the key, and that's the key to understand. Gains always take 5 years or 59 and a half for it to be IRS penalty free, and then, of course, income tax free. So keep remembering, every time you convert, remember 5 more years on the gains on that part of that conversion as well.
One of the things that you've said to me over and over, Mark, is when you have this conversation with people and you start to show them the benefits of getting a little bit of this money, a little bit at a time, out of the tax wash, and how it helps you past age 75 or so, they look at you and say, I guess I should have been doing this 5 years ago, maybe, huh? And so just that, me hearing that from you so often, means to me that you should have this conversation probably in your early 60s, even if you converted a little bit while you were still working because you wanted to do the math and not get your income up so high. It's worth at least talking about it and starting to look at it. And with a market being down right now, that actually adds in another advantage for you, doesn't it?
If you come into my office and you want me to have a pity party for you because you have an IRA that's worth $4 million, and when you take RMDs, it's going to be $150,000 to $160,000 a year of income, I'm not going to feel sorry for you. It's just not going to happen. Now, if you want me to assist you in making that RMD a little less and do it sooner rather than later, we can have that conversation and talk about what that looks like. There's a lot of folks that'll say, but I don't want to increase my tax bracket. And I'll say, okay, well, let's look at your tax bracket. Oh, did you just move from 22 to 24? That's not devastating. And in the state of North Carolina, it's 3.99. So, it's a discussion to have, right? But if you're going from 24 to 32, maybe it does matter. And these are the types of things we like to talk about and understand. Is this going to help you in the long run? Because you don't want to have such high required minimum distributions, because you don't want to pay as much in taxes, maybe pay the taxes now, have something income tax-free later. Yes, if you do it over the years and you did Roth conversions through and through, and next thing you know, you're in your 80s, of course it's going to come out and look more beneficial later on. The question is, do you need the money? Do you need the income? Do we need to use all the assets around the planning tools? So this is an important strategic part. I mean, I sat down with a woman the other day, and we're looking at the lump sum of money, in terms of the different things she wants to do, and identifying more than likely the best thing for her is not to convert to a Roth IRA. But we just got to get to that point.
Well, let's talk a little bit about the advantages, because I'm talking to guys right now, okay? So say, for instance, you pass, all right? That usually happens. Man passes before the woman. And what happens to your wife is two things. Number one, she loses a Social Security. That's no good. And then the other thing is, all of a sudden, she is moving up to head of household, and she's a single tax filer. She is no longer a couple, and that throws her into a higher tax bracket. And I mean, there's a disadvantage right there for your surviving spouse. And then as she passes, then the money moves down to their kids, and they're probably in their 60s, and they're making the highest income they ever had. I mean, Mark, there are some advantages to look at here, and it's not just you beating Uncle Sam, but there are some definite advantages for your family here.
Well, you just brought up some huge ones. Yeah, I mean, if you're a single filer, just go on your phone right now, on your smartphone, and Google the tax code for married filing jointly versus single and what that looks like. Because you know what's going to happen? You're going to realize, oh my gosh, the brackets are drastically different. So yeah, when you leave your surviving spouse, it's going to be highly different for that person. And then when they leave the money on, the rule is that your kids or whoever might be inheriting the IRA from you, if they do an inherited IRA, they have to exhaust the entire thing within 10 years of your death. And that also means they have to take some type of required minimum distribution each year, which I'm always going to say, look, you're going to want to take a nice chunk each year because you don't want it to be such a big backlog at the end. Unless we figure it out, your taxes won't be so bad in 9 or 10 years. It just depends on the plan. But yes, when you're talking about leaving $3-4 million of taxable money versus eventually turning it into something that could be income tax free, maybe at a lesser degree, but to what extent, and the fact that you're growing it and growing it and it becomes tax-free, there's a lot of advantages with that.
These are rules that are in place right now that you can explore and figure out. Maybe you don't have any heirs that you're sending money down to. Okay, you're in a different place. But if it's going to go to charity, that's another thing. So there's a lot to discuss when it comes to your 401k, your IRA, and the tax liability. Having a strategy for taxes is probably a pretty important conversation as you sit down and talk about retirement. Give Mark a call. Let's sit down and talk through it. Here's the website. Here's the number, moretoretire.com. Moretoretire.com. Just spell it right out. And there you'll see a place on the website where you can put a little information in there. Mark reaches out to you, starts the conversation. The meeting is no cost, no obligation. Sit down and talk about your retirement. Or you can start by doing this. Give him a call. It's 984-300-1984. 984-300-1984. Well, I don't know how you're using Uber these days, but Uber has a new feature. Women passengers can now request a women driver, and women drivers can now request women passengers. Uber says it's designed to help make women feel more comfortable taking Uber, and probably a safety issue too. I think, I put my wife in an Uber. I feel a little safer when she's going in there with a woman driver. I get that. But at the same time, we need to be listening to our women when it comes to our retirement as well. And Mark, the whole idea, I mean, we just discussed it, is so common for a man to pass away first, the woman to be left behind, for her not to know the strategy, for her not to know where the money is, for her not to know what the whole design is of retirement and how this is all changing. That's not right. She needs to be involved, whether she kind of wants to or not. Talk to me about that challenge. Do you have men that show up alone and you go, where's the wife? And you go, well, she's not really interested. So how do you deal with something like that?
Well, after I shake them for a few minutes and say, wake up, I need your wife here. No, I'm not going to do that to you folks. I mean, no, truthfully, I would like to meet with both, regardless of how the other spouse does not want to even be there or remotely around. At some point, it becomes relevant. Yes, your mind starts to slip. Things occur, things happen, things change. Most of the time, not all the time, most of the time, that's going to happen to the man first. Not always, but most of the time. And that's why the woman they truly have to be involved, okay? Because eventually, sometimes I have to bring the children in too. And this is a conversation that usually should happen from the start. What I want to do is just say, look, this is what it looks like. I know you're disinterested now, but at some point you have to be more interested. But I think it's important for you to be on board and understand what's happening here. And I think it's key. I think it's strategic. And I think it'll matter later on because I've seen it matter later on with several of my clients over the years.
Well, women make a lot of decisions in the house when it comes to, I mean, my wife probably has a real opinion on what tires should go on my car. So if she's involved in that, she should be involved in the retirement discussion as well. To get you involved in the retirement discussion, let's start that. You've probably been wondering, who am I going to get to help me with this? And here, Mark is on the radio saying, okay, here's how I do it. Does that kind of go along with how you want to approach retirement? If it does, let's have the conversation, kick the tires, and see if you and Mark are going to be a good fit. That's really what we want here. Let's have that meeting. That's why he does it at no cost or no obligation, just to sit down to say, this is what I've done for retirement. This is what I want to do in retirement. Does that all match up? And am I headed for some troubles here? Let's have that meeting. Moretoretire.com is the website. Moretoretire.com or 984-300-1984. 984-300-1984. Well, we hear it all the time. The number one fear of people getting ready for retirement is, I don't want to run out of money. So then the second question is how much can I spend every year? Well, there's formulas on that, and we'll see how people are doing because we've got some data for you coming up next on the Marc Oslar Retirement Experience.
A simple piece of paper. It's something we use every day. For the most part, it does what it's designed to do. It sits there flat on your desk as a placeholder for information. But with a couple strategic folds, suddenly your flat piece of paper becomes an airplane and flies across the room. Your 401k is kind of like that flat piece of paper. It just sits there as a placeholder for your money. Marc Oslar can show you those strategic moves to take your 401k from just sitting there to creating the income you need for retirement. Call today for a free no-obligation meeting. 984-300-1984. That's 984-300-1984. Or online at moretoretire.com.
Welcome back to the Marc Oslar Retirement Experience. Online, moretoretire.com. If you want to talk about your retirement, let's get a date on a calendar. Here's where you can start, tool around, learn more about Mark. Moretoretire.com or 984-300-1984. 984-300-1984. Also, if you're listening to the show now and you kind of like what you hear, you want to hear a little bit more, the show is on our podcast as well. We put them all up there, and this show and past shows as well for the last couple of years. And you can check that out online at iTunes or Spotify under the Marc Oslar Retirement Experience. All right, so the fear of running out of money is a big deal. And that means people, when they get into retirement, sometimes, and we've talked about this, they don't spend. They are so afraid to spend and run out of money that they pull way back and they really don't enjoy their retirement. Well, here's two guys, David Blanchett and Michael Finca. And those names probably don't mean anything to you, but they are researchers and regular contributors in financial industry. And they did a study about how people spend by age. Okay, so here you go. A couple, 65 to 75, they withdraw about 2.1% of their nest egg as they get into retirement. When you get to 75, it goes up a little bit, 3.2%, and at 85, it goes up to 3.8%, probably because of healthcare situations. Now, Mark, when you look at those numbers, that's not even 4%. That's not the 4% rule. Does that kind of jive with what you see people doing, that they're spending that little of their nest egg?
Well, this varies too as well. I mean, it depends on everybody's individual situation, but I have clients that, they don't spend a whole lot of their nest egg. They might have so much income. It depends, like military. If you got somebody in the military, they have the military pension and they have TRICARE and these types of things, it might not be a necessity. Maybe it's more for growing the asset, maybe growing a business, real estate, stuff like that. But then you have situations where a person has worked their whole life for this nest egg and they really need to work off this nest egg in retirement. And they need to know, you guys need to know it's possible to retire off of a nest egg. And that's why it's important to understand, look, you don't have to necessarily pull out, 2% of your assets are 3.2 or 3.8. Oh no, you have to save $1.4 million. What if we could look at a lifetime income rider that's attached to a fixed index annuity that gives you that income at a higher level that might provide for you exactly what you need in retirement? Why don't we have a conversation about something like that in addition to other market monies you might be using and everything else? What we want to do is look at a consistent balance, really, more than anything else. Is what is your risk tolerance? And are we appropriately assessing your risk tolerance? And should you limit your income in retirement? Honestly, enjoy it. Mm-hmm. Spend it. I mean, I tell my parents to spend it. Truthfully, this is the time to do it because you're only going to live once and you don't get to take it with you. You can bring a trailer, you can put it out the front of your house, but when you leave this world, you're not taking it with you. So you might as well spend some of it.
This whole idea, and I think this started with the 4% rule, because if you don't know about the 4% rule, the 4% rule is this, and that is that if you take 4% of your money in retirement, you should never run out because the market gives you, on average, 7%. So you should always be running ahead. Well, if the market's going down, throw that out the window. But at the same time here, Mark, 4%, 3.8%, 3.2%, 2%, there's a lot of money that's not being spent here. And also, when I think of the 4% rule, even when you get into your 70s and 80s, when you have to take RMDs, required minimum distributions, the government tells you have to take 3.6, 3.8, 4%, 5%, 6% when you get into your 80s. You can't even abide by the 4% rule because of Uncle Sam. So, I mean, the whole idea of a percentage pull, this is what I'm getting at. There's another way to look at this. Is you don't pull a percentage of your money, you make your money throw off income so you don't have to worry about a percentage. And I think that's kind of where you come from, is let's have assets that give you income.
I do. And truthfully, when you look at income producing assets, they can come from so many different places. So if you're talking about having retirement income, we just mentioned one thing, a lifetime income rider. Well, how about even looking at other annuities where you're just taking a sensible withdrawal like you would off a brokerage asset too? You could do that too. But obviously you want to have at least a good distribution rate when you're doing something like that. The question is, how much volatility is there? And that needs to be approached because we talk about three things on the show: preservation, income, and growth. And you want to preserve a certain percentage of your money that you work your whole life for. You want to have income that has preservation tools attached to it. So this way, with everything else, you can have good, sensible growth. And how do you do that? You approach it by using income-producing assets. They're going to have lower volatility. And it's very important in retirement. That's why we discuss annuities and structured notes and things like that, because maybe you can build it off of those tools. And then there's also some dividend models we might have too that might be helpful. Doing a little bit of different things can really help folks look at how they approach retirement. But the whole 4% rule, that's out the door now because, yes, if you have IRAs that are valuable, and we talked about it, basically starts close to about 4% when you start taking RMDs, and that ticks up every year. The factoring table comes down, and the amount you're taking out goes up each and every year. And that can dip into the principal. And if you're also dealing with sequence of returns where we have maybe a correction in the market, that could have a drastic effect. And that's why we want to look at preservation tools. Please, if you've worked very hard for your money, let's have that conversation.
Yeah, we're having one of those times right now where the market is all over the place. I mean, we lost 10%, and I think we're settling right now in an 8-9% down. We were at 50,000, and now we're in the 45, 46 range as far as the Dow is concerned. So this is one of those times where you kind of look at things and go, I don't want this happening in my retirement. I don't like my money going backwards. If I was going backwards, I want to spend that money. I don't want to lose it in the stock market. So this might be one of those wake-up moments for you right now if you're close to retirement and saying, I think I need to have a real plan for my income and for my stock market money. Let's have that conversation. Moretoretire.com is the website. Look around, find out more about Mark, and give him a call. Get a date on a calendar, 984 984-300-1984 is the number. 984-300-1984. There's no cost for that meeting. There's no obligation that you have to do business with Mark. This is just you coming in and saying, okay, this is what's got me bugged. I'm getting close to retirement. This is what makes me nervous. How can you help? 984-300-1984. And Mark, as people go through your website, they're going to see your steps to more. They're going to see your process there. Why don't you go through that a little bit? Because as people call, they want to know what's going to happen next. Let's tell them what happens next.
Absolutely. So if you're talking about going to my website, which is More to Retire, and that's with a TO, okay, so moretoretire.com. And when you're on my website, you go under process. We have a whole process guide, and it's called Your Financial Pathway to More. More is just an acronym for Marc Oslar Retirement Experience. So as we go through that process, we start with a treetop view. Could be several different things. But what we're trying to do is get a macroeconomics understanding of your situation. We look at it from the treetop view. We see buckets of money, and we want to understand why those buckets are the way where they are and what you're trying to do with those buckets of money. We want to understand your retirement desires and dreams. That's part of step 2. And we want to put that all together into a plan and personalize your plan in step 3 and make you come in as a client. Because what's going to happen is through those processes and procedures, eventually as you become a client, we're going to also have our annual reviews, and we're going to make adjustments, switches, and changes because these things are apparent. They have to happen because in life things change and we have to be ready for it. And then 5 is just ongoing support. So understanding how we go about our process and what we do, we want to be more for you. And that's what we want to be. We want to be helpful. We want to be a guide. And that's what we're looking for. You come into my office, you meet me, we have a good conversation. Yeah, you got some old annuities. Let me take a look at them. You got some variable annuities you don't like? Fine. You got some brokerage assets you want me to take a look at? We'll run a Morningstar report. We can do all of those things for you, and we'd be glad to do it.
When you think about it, having someone like Mark on your phone, you hit number 2 and there's Mark, and you give him a call. You might go down to Florida on a vacation, and then all of a sudden you find the perfect timeshare, or you find the perfect condo that you want to get into, and you go, I wonder if I can do that. These are the kind of things that happen while you're in retirement. Or it might be, man, I need a new car. Do I rent the car? Do I lease the car? Do I buy the car? What do I do with the car? All these different financial questions are going to come up in your retirement years over 20, 25 years. To have Mark as a resource there and to work it into your retirement plan, that's a real valuable resource. Give Mark a call, 984-300-1984, 984-300-1984, or moretoretire.com. So, Mark, in the first part of the show, if people were with us, we were talking about IRA, 401k to Roth conversions. And when you do one of those, the money that you have to pay goes right on top of your income. You're gonna pay taxes on that money that you convert. That, if you were taking Medicare, could change your Medicare payment. I have a story in front of me here that says as people sell their home, they want to downsize, that money could affect your Medicare premium. I didn't think that was income, but according to this, it could actually affect you. Tell me, how do we watch this? I mean, Medicare is about $200 a month. I don't want my Medicare premium to be $600 a month for a couple of years as I get my way into retirement. But for some people, that's a reality, isn't it?
Certainly. And we know that you have a deduction with regards to having your primary residence, right? Mm-hmm. But it's up, you're talking about if you're a married couple, but it's up to $500,000.
Okay.
So you got to keep that in mind.
Okay.
You know, that's number 1 on the list. Number 2, also, is this an investment property? Because that matters as well.
Okay.
3, have you thought about 1031 exchange options? You know, so these are a lot of different things that come up. Now, people say 1031. Well, yeah, it means you got to go real estate to real estate. Well, there's several different things you can do there. You don't necessarily have to go directly into another property. There's there's a whole website dedicated to Delaware statutory trusts where people can attach themselves to individual different types of investments, usually something like a private placement. And when they do that, it attaches to different properties, and then there's certain parameters that these trusts will allow, and then there's certain returns that people may make off of these investments, right? But at the first, right? And then you've also got the newer opportunity zones that are popping out, right? So those are coming out too, and that's another thing because Trump brought those back, and that's another way people can work. And then there's another option out there, and like I said, if you don't want to do, going straight into a property, or if you don't want to do a Delaware statutory trust or an opportunity zone, if you're selling a business or a real estate that's very appreciable, there's another option out there. And I'd be glad to share the resource with you sometime. You just got to reach out to me and we'll talk about that. But again, we assess everything in a person's portfolio whenever you're selling anything, because we want to know how the tax liability is going to hit home, where it's going to hit. You don't want it to hit the solar plexus, right? So what we want to do is make sure that you're protected there. And how do we do it? Well, we just, hey, what are we dealing with? What are the potential tax liabilities? Are we going to talk with the CPAs about this? Are we going to talk with your tax attorney? Whoever it might be, we want to be a part of this to make sure that you're making a good financial decision for you and your future, because it could affect your retirement years, like this example right here.
It's crazy because you save well, you've done your job, and then you get penalized because you get so much income in retirement. I want to make sure I have $100,000 a year. Okay. And your Social Security gets taxed and your Medicare premium goes up. Or you do what we talk about, you try to make a smart tax move and you do some tax conversions from your IRA, and your income goes up and your Social Security gets taxed. It's the balancing act that you have to do math-wise here, Mark. It seems to me sometimes when people try to do this themselves, I can see how it would go awry very quickly.
Yeah, and that's the thing, is that as you get older too, you get a little bit less patient with these types of things. And then sometimes the mind can be affected, and because you're getting older, it just happens. You slip a little bit, and you realize, I don't think I can do this myself anymore. And that's why it's good to have an advisor, especially when you have a lot of moving parts. If you have a lot of assets, a lot of moving parts, if you don't involve an advisor, involve the advisor at least for your spouse, because at some point, somebody's going to need one. And it's really good to have that relationship. So for us, we're just looking for the relationship, have a conversation, see if we can offer some products and services in addition to our brain, which helps, because when you're working with me, the most valuable resource you're getting from me is my experience and my brain and what I bring to the table for you. So I could have some strategic advice that could come across. You might say, you know what, I really want to talk to this guy. I want to know more. Everybody has products. Everybody has their own way of doing things. We could do this 10 different ways, right? But again, it's who you want to work with and how you want to get to know the person. And is this a person I want in my corner? And for me, I've gotten to the point in my career where if I like a person, I really hope they want to work with me too.
You're one of the great guys in my life, Mark, and I like you an awful lot. But my vision of a financial advisor is I'm not coming to see you that much. I want to go out into my retirement and I want to enjoy it with confidence. I want to go on a cruise. I want to go on a trip. I want to go do the stuff I want to do. But I don't want to be calling you all the time saying, Mark, can I do this? Can I do that? That's kind of like me being 16 and asking my parents for, date money. I don't want that in my life. And I love the idea that, we're going to set you in a plan and do the work up front, the hard work up front, so that you can kind of go off and enjoy your money and enjoy your retirement with confidence, and then come see you every year, twice a year, something like that, and say, are we okay? Do we have to make any moves? No? Good. See ya. That's kind of where I want to be.
Hey, that's not a bad thing at all. I had a client, we talked back and forth. I hadn't seen him in a while. It's been a few years, but we've had conversations, right? And I said, I really want to get you in. I want to go over this. You have this, annuity. And I think we might want to look at an internal switch because the company happens to allow an internal switch. I think I want to have this conversation. I'd like to have a conversation with you and your wife. He said, well, we'll start it with me. I'll come in. He said, and I said, well, what time? We're arranging the time. He said, yeah, we'll just do this time because I really just want to get it over with. And I said, and he said, well, I don't want it to sound bad. I said, I don't care. Just come on in. It's okay. I don't take offense. It's no big deal. Of course, we're going to, shake hands and we're going to do our best. But yes, eventually he brought his wife back in and we discussed it a little bit further because in this case, I mean, there are times where you have annuities that are older and some of the companies all offer internal transfers and they offer benefits for doing it. And you want to have these conversations because why? It's important. Same thing with brokerage stuff. When you're operating from fiduciary standard of care, that means you have to put everybody's needs that you're working with ahead of yours and everything else at the table. And so that's an important conversation to have. So we want to operate, as much as we can with the highest degree of care and skill and diligence, and we want to do a good job by you. And yeah, if you don't want to come in, you want to have a conversation, you want to see me on Zoom, and don't want to beg me for money, you don't have to beg me for money. Believe me, I promise.
Yeah, going to Mark should not be like going to the dentist, okay? It should not be that, all right? You're listening to the Marc Oslar Retirement Experience online, moreToRetire.com. To get in touch with Mark for a no-cost, no-obligation look at your retirement, really just an opportunity to talk and get your questions answered, 984-300-1984. 984-300-1984. All right, Mark, you got 3 girls over your lifetime here with these girls. Have you ever brought them down to Disney? Have you done the Disney situation?
We got to do a market correction here, Randy. I've got 4 girls.
Oh, did I say 3? I'm sorry. You got 4 girls.
Look, that's what happens. You lose count.
You lose count, especially at Disney. We're missing one here. I've done the Disney thing. I'm sure you've done the Disney thing. And Jim Gaffigan, the comedian, has also done the Disney thing. Apparently, he's done it too many times.
And I know there's a lot of people that love Disney, and I just want them to know they're wrong. And I should know. I've been multiple times, and I realize Disney is like, for me, it's like jalapenos. I never learn. I always think I can handle it, and then a couple hours later, I wish I was dead.
There are 50 million people a year that go to Disney World, just Disney World down in Orlando. And I think they're all there when I'm there. But anyway, so he doesn't seem to be learning his mistake, going back again and again and again. So I wanted to ask you that before we leave today. Is there a mistake that you see people make that it seems like it's something that people do over and over again? Maybe not just one person, but the same mistake that you see people make when it comes to retirement?
Couple things here. First, I do like Disney. I just get worn out real easily because it is not a vacation; it's a trip.
It is.
Okay, there's a huge difference, and it's a massive undertaking to go to Disney, to go to the different parks, to visit they call it Disney Springs now. It used to be Downtown Disney, but it's the same thing. Incredible stuff, right? Fantastic. Okay. Now let's compare that to your retirement. Well, they get financial amnesia. They kind of assume, and we all know that assume is not a great acronym to use for a lot of people to understand what's going on there. Mm-hmm. So we want to get it right. And don't assume anything for retirement. Let's get the facts on the table and understand exactly what you're dealing with so we can answer those questions. I'm talking to a person right now who became a client several months ago, but not fully. And now they're pretty much ready to fully go that way and, pass that money over and let's really have that conversation of where to put the money from this point and discuss every single need possible from now till they retire in 3.5 years. That's really important, and you got to be strategic. Once you do all those things, then you can be like Randy. Hey, Mark, you did your job. Thank you. I'll see you in 5 years. But
I would come and see you anyway, just to hang out with you. Do you think people wait too long to sit down with a financial advisor? That they wait right until the end, right before they retire, where there could be so many benefits coming in 2-3 years early, like what you just talked about there?
Yes, because we have so many relationships and financial resources and people we know. It's not just about me. It's about all these people around me that I can refer you to that can really help your life out. I mean, if you've got a very appreciable business, you've got a lot of real estate, you've got investments you've built up, or you're just working off a pool of money and you want to make it work for retirement. Every one of those situations applies to talking to someone like me. I just truly want to meet everybody I possibly can all around Cary, North Carolina, all around this area. And I do a lot of Zoom appointments in different states and stuff because I want to meet as many people as possible. I want to be global. I want to help as many people as I possibly can because that's my objective in life. And so if you're looking for someone to get you on the right path or just to help you with some really helpful relationships and some pieces of information I can provide for you, that's what we're here for. And that's what we want to build. We want to build together.
There's a lot of information on the internet. Yeah, you can go out there and find a ton of stuff about retirement, but it's not all going to be about you and retirement. Let's do that. Let's have that meeting and say, here's what you've saved. Here's what you want to do. Here's what your monthly bills are, and put it all together. That's the key to retirement planning. Let's have that meeting. Give Mark a call. Give him a look on the website, moretoretire.com. Again, moretoretire.com or 984-300-1984. It's a no-cost, no-obligation meeting. Let's get this going and talk about your retirement, see what you're in for, and plan through it. 984-300-1984. That is all the time we have for today. Thank you so much for listening. Remember our podcast on iTunes and Spotify. We'll be here next week. We hope you will be too. Have a great weekend.
Insurance products are offered through the insurance business Marc Oslar Retirement Experience. Marc Oslar Retirement Experience is also an investment advisory practice that offers products and services through Impact Partnership Wealth LLC, a registered investment advisor. IPW does not offer insurance products. The insurance products offered by Marc Oslar Retirement Experience are not subject to investment advisor requirements. Investing involves risks, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims paying ability of the issuing carrier. This radio podcast is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be considered as advice designed to meet the particular needs of an individual situation. Marc Oslar Retirement Experience is not permitted to offer, and no statement made during the show shall constitute legal or tax advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein are provided by third parties that have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Marc Oslar Retirement Experience. Market Guard is a firm that provides investment signals as well as portfolio allocation recommendations for a wide variety of model portfolios. Market Guard does not offer advice or enter into fiduciary relationships. Please remember that converting an employer plan account to a Roth IRA is a taxable event. Increased taxable income from the Roth IRA conversion may have several consequences. Be sure to consult with a qualified tax advisor before making any decisions regarding your IRA.